Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&amp Consulting and Len Suzio of GeoDataVision.
Len, always a pleasure to see you. So what interesting topic are you bringing to our discussion today?
Well, Dean, I've been advising banks since 1994 regarding their CRA responsibilities. And today I want to discuss a CRA topic that I've never heard anyone address before. I'm speaking of the optional loan data that a bank can present to examiners for consideration during a CRA exam. Now, many bankers think the only thing that counts in a CRA exam is the data explicitly covered under the Community Reinvestment Act. So everyone naturally focuses on small business loans, small farm loans, and community development loans. And certainly those loans are the main focal point of CRA exams. But there are other activities that examiners will consider if bankers present data related to meeting the community's need for credit services during an exam. And those activities can make a difference in a CRA exam rating if they are presented to examiners.
Wow, that does sound interesting, Len. So what activities are you talking about?
Well, it's important to keep in mind that CRA requires a bank to, quote, meet the need for credit services in the communities they serve. And aside from the typical lending activities specified in the regulation, there are these other lending activities that can present a more complete picture of how a bank is fulfilling its CRA mandate. First, I would cite what's called CRA Loan Type 3, other loans, lines of credit for business purpose. These would include loans that are small business loans, but which have been disqualified for technical reasons. A good example is asset-based lines of credit. Frequently, lines of credit that are secured by a lien on accounts receivable and inventory are supported by demand notes. Now, this means that when those loans are renewed annually, they don't meet the definition of a renewed loan under the Community Reinvestment Act, which requires that the maturity date of a note must be extended to qualify as a, quote, renewal, end quote, under the CRA definition. Many banks do extend asset-based lines of credit and are denied recognition under the regulation, even though this is a common and an important form of financing for small businesses. Examiners won't even know your bank is extending this type of business credit unless you present it to them. These loans can be collected under what's known as CRA Loan Type 3. Now, it's also necessary that you geocode those loans and that you collect the gross annual revenue data so that the loans can be evaluated under lending tests 3 and 4, the geographic and borrower characteristics test. A word of caution is in order here, though. In order to get credit, you not only must present the data to examiners, but you must also show them that the data is reliable. The free FFIEC software, as well as all commercial CRA software, does have an edit check utility that helps identify any potential data errors. Run the loans through the edit checks and correct any errors identified or document why a potential error identified by the edit checks is not an error. That way you are assuring examiners of the integrity of the data. Number one priority for any exam.
Okay, well that sounds like something that may help a lot of our listeners to demonstrate that their bank is fulfilling its CRA responsibilities. But what other types of activity should the bank track?
Well, another type of business credit frequently extended by community banks is standby letters of credit. Now, typically, standby letters of credit are needed by local contractors who have won a public bid and must post a bond or letter of credit as part of the qualifications. Since these are not actual loans, you can't report them as CRA Loan Type 3, but they are real extensions of credit that are helpful to many small business contractors. So again, a bank should geocode those credit commitments and collect the gross annual revenue and then present those accommodations to examiners for consideration, and is another good example of how a bank is meeting the need for credit services in the community it serves.
Okay, there's two different types of lending that aren't typically presented for consideration in a CRA exam, even though they undoubtedly are helpful to a small business community, as you point out. And I know that, of course, given your experience, that you have all kinds of other little tricks up your sleeve, but are there any other types of loans you suggest our listeners collect and consider presenting to examiners during a CRA exam?
Oh, definitely, Dean. I would be sure to track the number of dwelling units financed in the bank's HMDA. Examiners tend to look at all HMDA reported loans as a single family housing. One mortgage is as important and impactful as any other mortgage. But that could be very misleading. Many mortgages finance not only multifamily facilities, but duplexes, triplexes, and quadplexes. This information is reported under CRA, but is rarely considered by examiners on their own initiative. I would suggest to our listeners that they collect this data and evaluate its distribution by tracked income class. A few years ago, Dean, we were retained by a bank to help them avoid a less than satisfactory CRA performance rating, as well as a potential referral to the Department of Justice for redlining. When we examined their HMDA reported mortgages, we discovered that although they extended only a dozen mortgages in the assessment area low and moderate income tracts, those 12 mortgages financed the development of more than 700 apartments. In other words, the impact on the low and moderate income census tracts was 60, that's 60 times more impactful than the mere count of the number of mortgages that were indicated. When the bank presented this to examiners, it made the difference in getting a satisfactory CRA performance rating, and also it helped avoid a referral to the DOJ for potential redlining.
Yeah, Len, I can attest to what you're saying. We at M&M collaborated with you on this to help the bank out. The additional information was absolutely critical to passing their CRA exam and also avoiding redlining accusations. I can't even speak today, Len. My apologies.
It's
It is a
Monday
Monday.
morning.
We usually do these on a different day of the week, but please forgive me. But is there anything else you'd like to add? I got my tongue all twisted in a tie here, so but I figured I'd ask if you have anything else to add during this podcast.
Oh, yes, Dean. If you recall, it turned out that about 30% of the apartments qualified as affordable housing. I'm, of course, referring to that
Yeah, yeah,
situation we just talked about, a
I
fact that
do.
also made a big impression on examiners. So, any data about the number of affordable housing units financed should also be presented. And by the way, insofar as CRA credit, community development credit, is concerned, only multifamily mortgages that finance affordable housing are counted. But if a bank has financed duplexes, triplexes, or quadplexes that contain affordable rental units, I would recommend that a bank collect and present this information as part of painting the entire picture of how a bank is meeting the community's needs for credit. They may not get credit for community development, but anything that helps address the shortfall of affordable housing is important and should be recognized.
Yeah, I mean that's just a great heads up for sure. And again, I this this resurrects that whole thing we were working on, and it reminds me of things that I got to look for as we move forward. But is there any other type of lending that may not be reported that a bank should track for potential CRA credit?
Yeah, I have a couple more examples, Dean. First, I would suggest if a bank extends a relatively significant number of automobile loans, they may want to collect that data too. Many low income borrowers can't afford a mortgage, but an auto loan may be very important to their being able to get a job that pays them a decent wage and eventually may help them to earn a living that will qualify them for a home mortgage. Auto loans are CRA loan type 3 in the FFIC software. Don't forget to geocode the loans and to record the income of the borrower.
Yeah, that's a great point for sure. Because I think that most people would not think of automobile lending in that way, especially for CRA purposes. But any other types of lending you want to recommend to our listeners before we head out for the day?
Yes, Dean, there's one more example I have in mind. Many times a bank will extend a loan to small businesses that help them expand and therefore results in job creation. But if those loans are for $1 million or less, they don't count for community development credit unless they're an ISB and they're being evaluated under the ISB performance standards. Nevertheless, I would make examiners aware of these loans and the jobs created by the expansion of the business. Almost every community needs help creating jobs, and therefore those loans should be recognized as helping meet an important community need, even if it doesn't fulfill the definition of community development. It nevertheless is part of a bank fulfilling it's CRA responsibility to meet the credit needs of the community.
Yeah, well, this has been fantastic. You presented some interesting ideas today that may open the eyes of our listeners to the opportunity for CRA credit for those activities they may not have considered before. And usually we're talking about the new CRA rule, the old CRA rule, and whatever else is going on within CRA. So I thought this was very, very good. And in some cases, it may help improve a bank's CRA, a CRA rating. But in all cases, these extracurricular loans may present a completer, a more favorable picture of the bank meeting that community need for credit. So excellent presentation and great heads up. This is Dean Stockford with M&M Consulting.
And this is Len Suzio with GeoDataVision saying, we hope you enjoyed today's podcast. And as always, we encourage you to send us your feedback and any ideas you may have for future podcast topics.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and GeoDataVision on LinkedIn for all the latest news and information on compliance hot topics.